their impact on financial services and banking. Please let's all welcome Hadi again on stage.
Hi, I'm Hadi Kabalan. For those of you who saw me earlier, I've been investing in banks and technology companies for the last 20 years. Last 2 years, I helped build a company that puts private company shares on blockchain and worked very closely with a lot of the regulators in the countries that we're in. And the group is currently involved in building a hybrid fiat and crypto bank, again, in one of the developed market jurisdictions. So rather than go into a lot of the technicalities, I just thought I would give you a banker's perspective and a central banking perspective on cryptocurrencies, what it means. So we have 20 minutes. What I propose is I spend 10 minutes giving you a little definition, telling you about the cryptocurrencies, scaring you a little bit, and then telling you about ways that you can compete, and then we can open it up for questions. So here we go, technology, right? It's not working. So if not, I can just give you, oh, okay, perfect. Bankers will recognize this, and I see people are looking at it, and I think a lot of smart people in the room, I can leave now, because a cryptocurrency is this, and it's nothing as a banker that it's scary or that is unknown. We've dealt with this for centuries. It's a unique record that is tradable for value. Okay, so think about what that is. It's everything you've ever traded. It's a unique record that's tradable for value. Just so happens that it's a blockchain record, which gives it specific characteristics. And with a blockchain record, you've got it is uniquely secured through cryptography. So you're not relying on a specific institution to say this thing is true. You're relying on mathematical proofs to say this thing is true, right? So that's where the uniqueness comes from. Once it's verified by the network, it can no longer be deleted or modified. So, and this gives it that characteristic of transferability. Actually, you don't transfer a crypto asset, you transfer the private key that gives you access to it, but that particular characteristic gives it the transferability. It's available to every participant on the network. And this is a really big deal when that network is the internet, because it's everything and everybody. The consensus mechanism is what gives the trust of the network that the validity is there, because again, you don't need one person to approve it, you need a consensus. And no central point of control. I'm going to come back to this tradable for value, because a cryptocurrency is not necessarily a security always. Sometimes it is. There's another regulatory panel here that will take you through it. But there are some countries that have said that some types of tokens are not securities, but they're still cryptocurrencies. I would encourage you to try out the CryptoKitty game, because CryptoKitties are tokens that are unique. They have their own DNA. You buy them. They breed, so they give you a dividend. You can resell them for value, for money, right? So is it a security? Is it not a security? Currently, it's a game. But this is how the digital first world starts. It starts with games, and then it evolves. And you've seen it in every digital media that you have experienced, whether it's VR or anything. You know, digital first, mobile first, you start with what's a game. So it comes back to, what does it mean to put something on blockchain? What does it mean to have a cryptocurrency? It's mass market customization. And I say mass market and securitization. And I say mass market securitization because, again, as bankers, we've had securitization for decades, centuries, right? It's just securitization. Done it with everything. Done it with real estate. We've done it with other funds. We've done it with oil. We've done it with commodities. But it's never been the case that someone could buy $10 worth of a securitized asset, or $1 worth, or $200 million worth, and from anywhere in the world. Could they be in Antarctica? Could they be in the US? Could they be here? Okay. So that's what I mean by mass market securitization. And then the other thing that is actually quite a big deal from a banking perspective is instant settlement. Because instant settlement means it's global. It means you're not relying on SWIFT, and you're not relying on correspondent banks. And you're not relying on the other party being validated by another third party. It's instant settlement. I'm going to jump very quickly to what happens if a central bank in a country issues its own cryptocurrency, because it's been tested. There have been many meetings where we've had these discussions, we've tested and so on, and technically today it's possible. It's there, it's available. So what you end up with is digitally programmable money. So currently your deposits that are in the bank, they are electronic, but they're not digitally programmable in the sense that when it's a cryptocurrency that is issued by a central bank, each individual unit is unique and has a direct relationship with the central bank. So think about what that means for the banking system. It means that you can then have a very directed monetary policy. You can say, I'm going to inject $10 billion into the economy for housing, but you can't spend this on anything other than housing or healthcare or anything else. You can also say, I'm going to inject $50 billion into the economy because there's a recession and I need you to spend it in the next 3 months. And if you don't spend it in the next 3 months, can we leave the questions for after, please? It will expire. It will expire or it will depreciate very rapidly. So now you have the technology where you can say, I can digitally program money. And I can track every unit, right? So I can track every unit of the currency. Everywhere it goes, I'm the central bank. I have complete visibility. I have like the God's eye view. And so that means that the commercial banks face a lot of risks in this context because, yes, they can be part of the validation network. They can be part of the network that says this is verified as a record. But if I have a one-to-one relationship with the central bank for my money, what do I need to deposit at a bank for? So, and similarly, if there's no deposit at the bank, who's lending me? Who's taking the credit risk? These are very, very deep questions for the banking industry. So this is not a trivial thing because banks stand to risk very severe client loss in this context. Now, the good news is they're not going to do it. They're not going to do it because even though technically it's possible, in those countries that I know of where it's been tested, it's not politically or philosophically acceptable, right? For a couple of reasons. First of all, and this is probably the biggest one, if you were to suddenly end the fractional reserve banking system, you're going to destroy the economy. Let's say on average for every $1 of deposits, there are $10 of loans. If suddenly those deposits are no longer in a credit creating system, you're going to lose the loans. and the economy will just fall apart. So this is the key philosophical, political risk. The social and political and economic ramifications are not acceptable today. And I say today because in a generation or two, they may have a different philosophical perspective. Or a specific country might have a different philosophical perspective. It's the sort of Austrian School of Economics kind of thing. People want to look it up. The other thing is that central banks that at least that I know, have spoken to, will actually tell you we don't have the mandate as a central bank to take on the role of credit creation in the economy. We can vary reserve ratios, we can have monetary policy targets, but it's not our role to lend this company this much money or not, or give Hadi a car loan or not. So they know that. And even if they were to take on that mandate, they just don't have the expertise in-house. So they're not going to do it today. But they are testing something else, which is deposit non-fungible sovereign cryptocurrency. And I say deposit non-fungible because this is exactly the replacement for notes and coins in circulation, not of the money in your bank account. So this is where you go to the bank and you go to the ATM, and instead of taking out a note, you charge up some cryptocurrency. That's a sovereign cryptocurrency. This is very interesting. Already in places like Sweden, there's almost no cash in circulation. And so if you have that appetite from the consumer base, it's something that is interesting to experiment with. I would say this is more likely to come through than deposit fungible. Now this can be also subcontracted to commercial banks, right? Because this is something now that does not that is the exact equivalent of notes and coins in circulation. You could say this has been issued by Bank A for use in the country, or Bank B for use in the country. Because it's never going to leave the country, because it's not in the deposit system, it can only be used domestically. Now you can subcontract that. As a bank, you have to think about a lot of things. And this comes back to the fractional reserve banking question. Let's say you have a bank, and let's say you have a deposit base that's 100% fiat money, and you're loaning what you can, according to the rules of what country you're in. Now, in your bank, some of your clients want to own cryptocurrencies. Maybe they're sovereign, maybe they're not sovereign. By the way, in most countries, from a tax perspective, non-sovereign cryptocurrencies are treated as commodities, as if you're trading oil futures or something like that. There are some countries where one or two have been defined as currencies, like in Japan. And Switzerland came out with a regulation recently that has various specificities. But generally speaking, you have to deal with the fact that you might have deposits in your bank that will no longer be lending ratio qualified. And as a bank, you have to be very careful about how you manage your liquidity in that context. As a country, also. You can prepare. There are a lot of things that banks do as a platform that are not necessarily to do with their balance sheet. So this idea of the castle of the banking system is the balance sheet is being disintermediated by digital. This is just a part of it. The blockchain thing is just a part of that. But banks are being separated from their balance sheet in terms of their relationship with their customers. So what can you do? You need KYC for everything you do in the world, especially cryptocurrencies. So to the extent that everyone has been doing FATCA, to the extent that everyone has been getting to know their customers, you can have a platform as a bank of being KYC as a service. You can develop crypto custody, because right now most people have their crypto on a little USB at their house or at an exchange that's not safe. If you're a bank and you develop crypto custody, you'll be rewarded. You can develop peer-to-peer lending platforms so that you can still lend and apply your credit function, but not necessarily with your own balance sheet. And then, and finally, you want to think of it as my customers are my network users, and figure out anything that you can offer that keeps your clients in your network. I'm going to finish off some predictions. I think the regulators will this year globally find a consensus on how to regulate cryptocurrencies as an asset class. The FCA has actually launched an initiative to get regulators globally together on this. So I think it's probably an easy prediction. I think another one that I think is probably quite easy is that one of the top 10 technology companies will issue a regulated cryptocurrency, a token of some sort. And I think also what we will start seeing is that emerging markets companies that are being held back by their ecosystem that is local are going to start tapping the global. And with instant settlement and global reach, I think we will see this year at least one company from an emerging market with currency control regime issue some kind of token. Thank you. Questions? Sorry. Cyrene, you had a question. Okay. Thank you very much, everyone.